This is Keisha here at TradeWithResolve.com, and this will be another episode of Trading Essentials. In today's episode, we will be discussing the terms long versus short. Now, if you're brand new to the stock market and you're new to the channel, feel free to go ahead and click the subscribe button. I'll release educational content when it comes to the stock market, as well as live trades and platform tutorials. So if you think that is of interest to you, please go ahead and click the subscribe button for more content. So if you're brand new to the stock market, maybe you've never heard of the terms long versus short. So let's go ahead and go over these two terms. So the term long simply means that you are anticipating the price of the stock to increase in order to make a profit. So the goal when going long is to buy shares of the stock at a low price in order to sell at a higher price. So let's go over a quick example. Let's say you buy 500 shares of Apple at $150 per share, and you decide to sell those 500 shares at $151. So the price went from $150 to $151. So that means you made $1 per share. You purchased a total of 500 shares. $1 per share multiplied by 500 shares means you made a profit of $500, and this would exclude the commission fees. So that is what the term long means. You are looking to buy at a low price in order to sell at a higher price. So if someone says, I'm long Apple, you automatically know that they are looking to make a profit as the price of Apple increases. So they simply believe that the price will increase. And the higher the price goes, the more profit you can make. All right, so that is the definition of long. So now let's talk about the definition of short. So you may have heard the term short or even short selling. They simply mean the same thing. They are synonymous. So if you hear the term short, you are simply looking for the price to decrease in order to make a profit. So whenever you go short or when you are short selling, you are actually betting against the company, anticipating that the price of the stock will decline. So the way that shorting works is you actually sell borrowed shares and you buy them back at a lower price in order to make a profit. So when you buy those shares back at a lower price, this term is called covering. So you sell shares and you buy them back at a lower price, which means you are covering the position. So let's go over a quick example here. Let's say you sell 100 shares of, let's say, Facebook. So you sell 100 shares of Facebook at $50 and you buy them back at $45. So this simply means that you just profited $5 per share. Remember, the price started out at $50, the price declined to $45, which means the price ended up decreasing by $5. You ended up selling 100 shares, so 100 shares multiplied by the $5 decrease gives you a $500 profit, excluding the commissions and fees. So again, whenever you go short, you are betting against the company and anticipating for the price to decrease in order to make a profit. So if someone says, hey, I'm short Facebook or I'm short Tesla, you automatically know that they are anticipating for the price to decline and they will make a profit if the price declines. So let's sum up what we have discussed in this Trading Essentials lesson. So again, we're discussing long versus short. Whenever you go long, you are anticipating the price of the stock to increase in order to make a profit. So you are looking to buy low and sell high. You make money if the price goes up and increases in your favor, but you lose money if the stock price declines. Let's go over to short now. So whenever you go short, you are anticipating to make a profit if the price of the stock declines, because you are essentially betting against the company. The goal when going short is to sell high and buy low. And you only make money if the stock price declines and moves lower. You lose money if the stock price moves against you and goes higher. You may be wondering, how can you determine if the stock price is likely to increase or decrease? So how do you know when to go long or when to go short? And there is a strategy that you can use called technical analysis. And with technical analysis, you are simply looking at the candlestick chart, and you can look for specific patterns to determine if the stock price is likely to increase or decrease. And it's really all about technical analysis and placing the odds in your favor. You just really need to be able to identify high probability setups so that you know how to determine if the price is likely to increase or decrease. Therefore, you will then know if you should go long or short. I hope you enjoyed this episode of Trading Essentials. If you're brand new to the stock market, be sure to check out the playlist of my Trading Essentials video lesson series. We're going to go over more terms like we did today to help you become familiar with some of the terminology when it comes to entering into the stock market. So be sure to check out my Trading Essentials video lesson series, and the link is provided below. Thank you so much for tuning in. If you have any questions or comments, please leave them below, and I look forward to seeing you in the next video lesson.